Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we'll talk about trading consolidations with rectangle patterns. Now, a rectangle is, well, it's a rectangle. It's pretty much what you would expect it to be. It's basically an area of support and resistance that gets tested multiple times, and then eventually you make a move. And it can be in either direction. Typically, consolidation leads to continuation, meaning that if you're in an uptrend, typically this means that you will eventually break to the upside. You cannot bank on it, though. And the best way to trade these things is to look at it after the fact. The great thing about it is that they have a built-in measuring stick. So, say this is $20. It's supposed to move $20 on a break above the high. A lot of times people will wait to see some type of candlestick close outside of it. That's really up to you how you choose to enter. You can be aggressive and do it right away as well, but it's also more risky. You could get a false breakout, meaning that they get through, but not enough to really get things going. Typically, the stop loss is put somewhere right about in the middle of the box, maybe just a little bit under, giving you a built-in 1 risk to 2 reward. Really straightforward. You want to see support and resistance show up a couple of different times to form a rectangle in order to trade it. So here in Ethereum on the daily, you can see that there is an area that the market had been struggling to get out of. You can see we tested it at least 3 times before breaking out. You can see that we tested the bottom 3 times, 4 times. The nice thing about this is it's a continuation. So you would have put your stop loss somewhere in the middle, and you would have aimed for $100, which you got in the very first day on the breakout. Furthermore, you can see that we came back to test this area. That's quite often the case. What was once resistance becomes support and vice versa. So if it was, breaking down, a lot of times they'll come back and test it and continue forward because it literally is just support and resistance. So you can see that you had multiple ways to trade this. You could have taken the breakout and taken your profit. You could have taken the breakout knowing that we had been rallying and this could be continuation and hold it until, whatever your criteria to exit would be. Or you could have entered based upon a retest of this area on this massive candlestick. So you can see clearly areas to, pay quite a bit of attention to due to the fact that we had multiple ways to trade. You can also make an argument for simply taking a look at this as a market that was messing around with 2 major big figures. And then finally, you've got the MACD, you've got moving averages. They all could be telling you the same thing. You can see that we broke the 0 going into it, dipped, and then crossed over right on the breakout, and the MACD took off. So clearly, plenty of reasons to take this trade. So Cardano did an almost identical thing on this daily chart. You can see it was right here. And this is why a lot of traders will actually wait for a close outside of this, a strong close for that matter. Because had you taken it at the very first tick above, you may have gotten stopped out. So that is the difference between being aggressive and being conservative when it comes to these moves. Either way, I mean, it really comes down to your risk to reward type of strategy. But clearly, this is a market that took off hard to the upside. So with that, I think what we're looking at here is the possibility that we could take an indicator such as maybe the RSI Put that on the chart. And you can see that we were overbought, so it's not a surprise that we kind of consolidated here. And once we broke out, we went parabolic. Not a huge surprise. You can also, put the good old trusty EMA here. It's a daily chart. You could use the 9. Again, I like using a little bit higher numbers on daily time frame and the like. You can see it's held up quite nicely. Cardano certainly made the projected move and much further. So Zcash, you can see this was a little bit different situation in the sense that it wasn't continuation, it was a reversal. But as I analyze this, you'll see why it wasn't really that big of a surprise. It doesn't mean that you knew right away that this was going to be the case. But take a look at this area here at $77. It had been resistance multiple times. So the fact that we came back up here and then got this nasty candlestick was a good sign that we were going lower. Here on the 4-hour chart in Zcash, take a look at the MACD, and you can see that the MACD right here, that's where we got the zero line cross, and you didn't get out until here if you were using the MACD. Furthermore, you could also take a look at just the round figure itself. You can see that 72 has been an area. 70, of course, is just below it. So the fact that we broke below 70 also means something from a psychological standpoint. You can see that we retested it the next candlestick. So rectangles they're relatively simple. And because of this, traders love trading them. And if you think about it, it's really not hard to understand why. Because a rectangle is simply, it's one of the phases of the markets. Markets are either trending or they're consolidating. And then later on, you might get something like a trend, consolidation, where more people get involved in the trend. But sooner or later, you get what they call distribution. Those who got in early are giving it out they're trying to sell out of their positions, and eventually they do, and the lack of demand sends this thing back down. Same thing works in a downtrend. There is something known as accumulation at the bottom, and what happens is people are in there buying up. In this case, it would be Zcash, maybe at a cheap price because they want it longer term, and then eventually it takes off. And once you break out of that rectangle, the great thing about it is it's a self-fulfilling prophecy. There are stop loss orders just above, like in this one. So if it broke higher, all of these stop loss orders are forced to buy the market. It just pushes it higher. If you break lower, there are buy orders that are down here, and they have to protect them with stop losses. So eventually you get to the point where they get blown out and they have to sell in order to cover their position to get back to zero. So it's a nice self-fulfilling, easily identifiable pattern. And with all patterns, the higher the time frame, the more obvious, the more people are involved. So that, of course, in and of itself, means that you should be looking at higher time frames and then drilling down. In the next video, we'll take a look at trading consolidations with Bollinger Bands.